Hi everyone, a very good evening to one and all present here. I mean, it's really great to have you all back. So, welcome to another session of Case by Case webinar by Smallcase in association with LotusDew. So, today we have Abhishek Banerjee, one of the most well-known fund managers and publishers that we have on board. We're really great to have Abhishek today. Abhishek, it's really great to have you today. And please tell a bit about what you're going to talk about. Say hi to everyone. Welcome to the show. Yeah.
Thank you, Abel. Of course, it's always great to interact with the small case customers. I must congratulate all the viewers because what you should kind of also understand is that most of you are not, first time investors or amateur investors. It's a step in the process or the journey of an investor where, you start by looking at the markets and you eventually decide that look, I'm good managing my portfolio, I understand how to do that, but maybe I can get a bit of help to look at some of the stocks that somebody else can, has the time and the is in the profession of selecting stocks. Helps me out, but I would like to decide what's my appetite, how large I want to go, when I want to put in money, when I want to withdraw money. So you're basically doing the job of a portfolio manager. We are doing the job of providing the research so that you are managing the portfolio on your own, and therefore, because it's a shared effort, the advantage is that you get to reduce the cost because you're doing part of the work of a portfolio manager, and we get to get great customers who understand what we are offering in a much more in detailed way, and is much more engaged than a passive mutual fund manager where he's out there and you ever hardly get to talk to him. So I enjoy this a lot, and I also enjoy talking to some of my small case customers. It's one of my favorite hobbies to call them and find out what is that they are doing in the overall portfolio. Some of the key questions I always get is how much should I invest? Is this the right time? Should I do an SIP or should I do bulk investment? What should be the right size of the SIP? What should be the frequency of SIP? So we'll cover all of these questions today. We'll give you not just vague generic answers, but specific researched answers on all these questions. As a second thing, I also want to tell you that this is I want to slowly take the level of the webinar right from a very amateurish folklore kind of storytelling to a little bit more technical, little bit more content driven sort of a webinar, where I expect also that my viewers, my audience, they would enjoy that, to really get into the nitty gritty, to work a real life case out in the webinar, to see for themselves how things are done. So that's the intent. As a start, we believe that the world is changing a lot, right? This is the landing page of our website, where we are saying that we care about your financial freedom, right? We care about the fact that one day you might not want to work for money. You might still want to work. It could be with the things that you enjoy doing, but it might not or need not be just for working for money. So that's financial freedom, when you're free to use your time the way you want to, and we can help you with our unique portfolios to get you there. But in this world, before we get into the macro, there's a very profound and important change that is happening right now, which is that as of now, what we have traditionally seen, right? Typically, the likes of Infosys or a TCS, or exporting service exporting companies, they had businesses all across the world, and they were able to collect global revenues and put it in a basket and call it a business in India, listed in India, and you could buy that business, and you can participate in this globally diversified portfolio of revenues just by investing in a local company. And this is changing, right? So you have Brexit, where Britain wants to move out of Eurozone. Different countries are saying we want to make in our own country, but we want to sell everywhere else. All the countries want to do that. There's customs, trade barriers. People don't want to create a balanced deficit in trade, so they want to raise taxes for imports, so that local companies can compete with cost of production which might be lower in a different country. So this is the new reality, right? And so therefore what you could do before, where you had let's say a portfolio where you had just locally listed companies to get a global wealth exposure, now you have to be way more careful. And there might be still some companies which will be able to do that, get global revenues, but their valuations might not be very attractive from an equity investment point of view. Or so you have two choices, right? If you go in the large cap space, you have to be really careful about how those exporting companies are going to earn, and what's the distinction between one large cap versus another in the revenue mix. But we are really a small cap specialist. So we think domestic smaller companies will thrive on this, where you will have smaller companies who are very local, very tied to the consumption, which is independent from economy, and delivering great value to customers and earning out of that. That's where the world is going to be. This is a 10, 15, 20-year thing that we foresee. We are at the very cusp of it. So that's how we are positioned. So hence we think that you should, of course, live local, enjoy the local environment, live locally, but do invest globally. And out of that global investment, when you're talking about your own portfolio in India, I think small caps or micro caps that we specialize in could be quite unique to your financial freedom. And that's what we want to accelerate with our efforts, and with your interest in terms of diversifying your portfolio into these kind of strategies. I'll also show you that it's not just that I'm kind of saying all this. I'll also show you performance wise, if you compare mutual funds on money control versus what we have been able to deliver. And these are all live performances calculated by small case. We don't influence performance calculation. You will see that we are actually the top performing small cap strategy among all mutual funds that you can buy for the last 3-6 months. We can see that in the returns. So with that, I'll just quickly take a moment to introduce my larger team. That's the board. So uh, on the board, of course, I have myself. I'm the founder and CEO. I'm co-founded by Dr. Prachi. She's a professor at Indian School of Business. Did her PhD from Stern. And also on the board is Klaus Nielsen, who is a former executive at Saxo Bank in Denmark. LotusDew is also a company that was part of the Nordic Fast Track program in Copenhagen FinTech, where Copenhagen FinTech Lab incubated us for some time. So there I met Klaus, and he used to work for Saxo Bank. Then now he's currently on the board of LotusDew. We are also advised by Samir Shah, who has been our supporter from day one. He is the currently the executive chair of Dora Trust, which is a NBFC based in Chennai, but he's also was the CEO of National Commodities and Derivatives Exchange. So we have a lot of help from regulatory oversight, as well as key members of the team who help us shape the business. One of the seminal events, right, which we want to talk about today, is the union budget. The union budget, as it's called, it's a finance bill, and it's basically a bill where, among other things, we draw out our projected income as a country and projected expenses. And because we draw the projected income, we also kind of understand how we are going to generate this income by way of taxes. So tax changes are part of it. What is very critical this time, obviously, which is not surprising, is healthcare spend has gone up quite significantly by almost 1.5x. Manufacturing forms the bedrock of most economies, because they have a huge money multiplier effect. So the moment you employ somebody at a skilled manufacturing job, usually they are marginal spenders, so they spend most of the money for consumption of their staples and discretionary items, and they create further velocity of money in the economy, which actually propels growth way more than let's say cutting taxes for the ultra rich, where they're habitually saving more than they're spending. So it's very important to stimulate manufacturing, which really drives the marginal spending in an economy. rail and road infrastructure building is always good for a country if they can afford it, because that has apart from the fact that it creates employment and multiplier effect, it makes industries and people more accessible to each other, which means that somebody who was probably not as advantaged in terms of accessibility, where you could have a mine or a resource in Bihar or Orissa, which are very mineral rich states. Suddenly you can kind of put that on a wagon on a rail and then send it to a seaport and get it exported for a better price. So these kind of opportunities open up when you start investing, and this has been the focus. It's kind of considered that this is a budget that is as seminal as the 91 budget, when Dr. Manmohan Singh, our ex prime minister, he opened up the economy as a finance minister to foreign direct investments and so on. So we'll have to see, but definitely the blueprint seems to point to a direction where there'll be heavy spending. And if you understand, just to look at what does it mean in terms of how they have taxed things, their impact on prices, right? So as I said, tax creates revenue, so import and export are an important part of this revenue basket. you know some trivia around customs: textile and clothing accessories will get more expensive because the cost of imports have been increased by adding more customs there. Automobiles, metal imports will become cheaper. Interestingly, I've been watching Chinese ore prices, iron ore prices, and they are reaching all-time high. So whatever we might be able to cut in terms of import duties for Chinese steel, we might still end up paying the same landed prices. So therefore, you might not see a lot of discounts in vehicles if you are expecting that to happen. But this is something which we'll have to live with. Mobile components, uh, essentially, what you see is that we are one of the largest consumers of mobile phone. I think it's very fair that most of them get manufactured in India, so that at least we can service our own hardware. So there's a higher barrier for mobile phone components to come in India, and a lower barrier or incentivized manufacturing to enable more sort of easier manufacturing of mobiles. So what this means is that uh, going forward, mobile components, mobile manufacturing might be something very interesting. Toy components will be taxed. uh, you know Toy is a big market. Indians have many consumers of toy. So, and I think that's another sector. One of the small trivia: because of our focus on renewable energy, solar inverters will be taxed 3x more on imports. So we want to make more solar invest in. But in general, what you see is that it'll be India is going towards more electronic based manufacturing, and is letting basic raw materials like metals and those kind of things come in. So we are trying to do more of finished goods in India, and we are trying to make it easier to import base materials into India, right? So it used to be the other way around, if you were to think about it. So that is the direction broadly where we are heading. I'm already seeing some questions. Thank you, Abel, but I'll park them. I think most of the questions I'm just glancing through should be or could be answered during the presentation. We have a lot of very interesting and deep material to cover. So please bear with me, and I will definitely answer the questions that are not answered by the time we get through the presentation. There are about 24 slides. We are at the fourth slide, so we are basically 1/6 down the way. So we'll just quickly go through the slides. India, so this kind of budget, right, where we incentivize so much borrowing, so much spending. In global macro terms, what that means is that the government is expected to borrow this money, right? Why will the government borrow? It's like they will pay from their future income. It's a bit like you wanting to borrow money to buy a home. Uh, you're typically you're going to get a home loan at 5x your annual income, right? So if you're making 30 lakhs, the home that you can buy is 1.5 crores. If you think about it in the context of a company, on an average, you pay 18 times earnings, right? So you should immediately see why entrepreneurship is something which is priced higher than personal income. But the point being that The moment you are willing to borrow, there's a multiple attached to it. So when you have already borrowed and you want to make additional borrowing, the next person who's going to lend you money will likely give you a little bit, will want a little bit of extra return from you, right? Just a bit extra, so that they can compensate for the risk. So with this sort of borrowing program that the government has put together in the budget, the 10-year yields, or the cost of borrowing for government over 10 years, has slightly gone up by 22 basis points. 22 basis point is 0.022%. It might not sound a lot, but it's a lot in context of where it was around 5.8, and it's 0.22 divided by 5.8, so that works out to be couple of percentage. So there, it's the crux of it. So these government bond yields keep shifting based on future demand of government bonds in India, and that is your cost of money, right? So that's at the cost of money, and then everything that you borrow as a corporate is this plus something else. So it's not a good thing for government bond yields to go up, because it increases the cost of money for corporates. And when cost of money increases, I'll show you, I have a little bit of surprise at the end of the webinar, where I'll kind of talk about a new framework of doing valuation with very limited data, right? It's like how you've heard how startups are deals are done on napkins on a restaurant, in a restaurant table. I'll show you, a couple of techniques where you can just get the feel of whether your company that you're looking at is, how valuable is it, overvalued or undervalued, very quickly. But we'll get to that. So but the point is that this discounting is what drives the value. So I'm going to quickly take you through a lot of slides now, so please pay attention, because it's very dense data and material, and I'll try to cover it quickly, and hopefully I'll try to make most sense of it. But it's again, as I said, with the caveat, it's a bit rich in content, it's a little technical in nature, so please bear with me. And if there's any slide you would like me to go back to after, during the Q&A, to explain it a bit more, I'm more than happy to do that. But let me just at least share the content quickly, so that we can have time for that later. So, let's talk about fiscal stimulus, right? What is fiscal stimulus? The world of economics is divided into basically two buckets, fiscal and monetary. Monetary is what RBI does with interest rates, and fiscal is what government does with taxes. So, fiscal stimulus here essentially means the government giving tax sops or tax incentives to stimulate the economy, right? So if you look at the chart on the left, US has done the most, India has done the least, which is, and this is before the budget, right? So this is basically what India has done compared to the rest of the countries in order to do taxation related changes and incentivization to stimulate the economy. So is this a good thing? Did India do the right thing by kind of not being in the top three? uh, what do you think? So the point here is that Indians are habitual savers, right? We like to save because we don't have a great deal of social security in terms of unemployment insurance or things like that. So we tend to save a lot. So if the government, let's say, from a monetary channel, printed money and gave it in the bank account of people, most likely it'll go back as fixed deposits, right? So this is essentially the problem that we see most of the time, that even if you give money to people to spend, we tend to save them a lot. And so essentially this is what we have to contend with. Hence I think the fact that India did not do as much and has so much more room left gives us a lot of flexibility in the future to do more of it. So it is in a good way for an emerging economy like us. The chart on the right, what I want to show you is, if you look at, this is the ratio of the total in emerging market index divided by S&P. So SPX is S&P, EEM is global emerging market index, both priced in dollars. um, EEM contains countries like Brazil, India, China, Korea, and a few other countries like, which are part of the emerging market basket, Argentina and so on. SPX is basically your S&P 500. So what you see is, over the last 10 years, right, um, emerging markets have underperformed developed markets. So if you thought that emerging markets would do better than developed markets because they can grow more. That didn't work out for the last 10 years. But there is, from a technical standpoint, there's a breakout, and there's a pretty good chance India will lead this. The fact is, because compared to other emerging countries which are very very tech heavy, India, the largest sector exposure is finance. So, financials. So why is this important? Because in a large developed economy, every part of the value chain, right, you'll have a bank, you'll have a specialty lender, you'll have probably a telecom credit card financing, SPV. You'll have multiple parts in the value chain which can be separately listed, and you can mix and match as to what you think your exposure is. In a developing economy, most of the people borrow from the bank directly. They might not have separable businesses. So financials becomes a very good way to get a broad exposure of an emerging economy, and India has about 30-40% financials in its index. So in this breakout, I think India can do pretty well. Now we'll go through the charts quickly because I want to cover about 15 charts in the next 10-12 minutes. On the left, you have the Sensex 30, which is the price index of the Sensex. On the right, what I want to show you, and that's one of the questions I happened to glance through. Small caps have not done really well. So why is that? Now they are going to do well. What has fundamentally changed? So look at this, right? Look at this chart. So this chart which I'm pointing to on the right, it's the ratio of the large cap returns divided by the small cap returns. So when this line on the right hand chart, if you look at 2018 to 2020, it's going down. So that ratio is reducing, which means the large caps have outperformed small caps, but it has turned around, right? So it is broadly, overall, why do small caps outperform? So over 10 years, your nominal GDP, which is your real GDP plus inflation, would be broadly the same as large cap returns. So which has been true for India in the last 10 years. You'll see nominal GDP, which is real plus inflation, turns out to be 9% is what you get in an average large cap fund. Small caps usually give you 3 to 4% excess over large caps over that time frame. And then a fund manager in India, and on an average, a median fund manager, right? I'm not talking about just an average fund manager will give you a little more above that, 1-2%, and a good fund will give you 2-3% above that. So technically in India, if you wait sufficiently, your CAGR of small cap should be in the neighborhood of 15 to 18% by this mathematics. If you go back in history, you'll find this to be true in times. What you need to watch out for is relative valuation, obviously. So that's how you should think about small caps in general. Now look at the price to earnings and price to book for India. The blue line is the price to earnings for India. The green line is for developed markets. What I want to show you is that if you look at the price to earnings, they are in lockstep in the with developed markets over the last 10 years. But look at the price to book. What is the meaning of this difference? The price to book, the chart on the right, it means that the book value has not been fully priced in to the extent that it has been priced in the developed market. So the price is way higher than the book value. So therefore the green line is below the blue line. In India, the blue line is higher than the ratio is larger. So one way to interpret this could be that there's a lot of value left in the books of companies that has not been fully priced into the earnings, or it's not and you can see this change, right? So if you look at the average capacity utilization of companies in India, they're almost reaching 80-85%. So you see this surprise in earnings because suddenly the assets are useful, people are consuming, and then they're able to optimize the manufacturing. This is an important thing. Another chart which is important is the purple line is financials, the red line at the bottom is technology, and this is again for Nifty 500 index. The point that I made, right, in India financials have always led the way. The reason is the technology exposure in our Nifty 50 index or even Nifty 500 index is about 15%, 20% in best cases. Do you have any idea, like, how much it is in Korea, or China, Brazil, and so on? So in Korea, for example, it's 40%. 40% of their index is technology, and we all know technology has been doing better than many other sectors recently. So w- but financials captured more broad economic growth. So going back to the first slide where we showed how the budget is positioned, and the fact that financials capture that activity, and the fact that India, the largest sector in the index is financials, that really makes it a very kind of potent mix from a going forward basis. um, if you look at the uh, you know activity level, so we keep hearing about this V-shaped recovery, things have recovered. Is this really true? Can you see it in the data? So yeah, you can actually see it in the data. What you can see on the right hand chart is Indian manufacturing and production. It definitely looks like a long V, which means look at the extent of which it dipped -40% and how quickly it came back up. And so the question is like, oh, I mean, that's fine, but the markets have rallied as well. Has it overheated, right? Should I just pull my money out and wait for a dip to get back in? I mean, nobody can actually time that, to be honest, but let's look at the data and try to make an educated guess, if at all. So you have all this stimulus, fiscal, monetary, come into the economy. Activity levels are back up, earnings are surprising. Do you think there will be a dip, even though the markets have rallied, and they have just rallied a bit above the pre-COVID levels? So if you think about it in a broad macro context, it's like, it's the tide has gone back up, but there's a huge kind of flow coming and behind it. And I think we should definitely try to maximize our wealth creation when there's so much of support for growth and future economic activity. The next slide I want to talk about is something which everybody knows, which is population, right? So so look at what is happening. The blue line is basically the percentage of 0 to 14-year-olds in the country on the left hand chart. The green line on the top is the earning age people, essentially, so people who are actually productive in the economy, and the unemployment uh, on the basically on the right hand side. So yes, during the COVID time, unemployment did pick up, but overall, if you look at the data that is getting measured, so now the question is, are we measuring the right data? That's a separate debate. But looking at the formal data, at least, I mean, it's not that bad a picture actually. And what you see is that the productive age people are a larger portion of the ratio of the mix. Therefore, they are the consumers. They're going to drive. That's the demographic dividend that people keep talking about, and this is in the data. What is concerning though is the labor participation rate. So what exactly is labor participation rate? It is basically a kind of in a very simple way, two things, right? Underemployment, I mean, people who have received the right education, are they earning enough? Second is everybody who is able to earn, having a job? And this is the problem. If you look at these two slides, right, the chart on the right and this chart where you see the sliding line on the left. So on one hand, we are saying, look, unemployment is coming down. On the other hand, we are also saying that labor participation is reducing. So this is kind of not reconcilable. And this has been the bone of contention as to what exactly is going on. And I think what is going on is that a lot of the labor participation is not getting measured because of the gig economy kind of jobs. So maybe that's just my guess. I don't know for a fact, but it seems to be one of the explanation I could offer. But it's really a paradox in that sense. And what you can also see is that somehow we are slipping on the global competitiveness index on the WEF parameter, which is not a good thing. So while we are producing more valuable work, we are becoming less competitive now, and the labor participation is decreasing. So if you again bring it back to the original first slide, this can dramatically turn around based on the manufacturing led economy and the infrastructure led economy. And I mean, maybe it's just, we as humans visually always try to look for patterns, but you can see this thing turning around. We'll have to see maybe a few more months, few more quarters to see what does it mean. But uh, and this is what people are calling green shoots. Uh, Again, employment type, as you can see, Indian public sector employment has peaked way back in 1998 2000. Since then, the private sector has taken over. So it's again this private consumption, doing your own health insurance, doing your own pension. It's a more DIY industry, DIY world. So this is where it is going. And if you look at the dependence ratio and the wholesale price index, what is interesting is, look at the green line on the chart on the right. It's called the core inflation, the green line. The blue line is WPI, which is the wholesale price index. So what is the difference between these two? Core inflation is inflation without basically one of the main components like energy, right? And WPI is just wholesale price index. What you notice is that the core inflation has inched up, but you also saw the news yesterday, if you, some of you did, where core inflation came back down. And this has been the main thing, right? So if connecting all of this together now and looking at the interest rates that we are trying to go by, the CPI, uh, what you see is that India has not done a lot of fiscal and monetary stimulus. We are spending a lot more, but we are our core inflation is kind of cooling off. So this, and for the first time after many years, Indian economy printed a current account surplus, which means that we exported more than we imported. If you put all of this together, it could lead to rupee strengthening. We have seen this happen when INR was 76 to a dollar. Now it's about 72. So it's 4 divided by 76, which is roughly 5% appreciation in the currency, is very important, right? Why is this important? Because, as I said, Indian companies in the listed market, they are mostly exporters. When exporters export, they get money in dollars, but they pay locally in rupees. So if your dollar is, rupee strengthens, they get less dollar, but they still have the same rupee cost, so their profitability decreases. So given where we are, given the fact that there'll be we are incentivizing exports, and we are raising trade barriers for imports, the inflation cooling down, we are import most of our oil. So if our rupee increases in value, our oil import cost goes down, which is great for fuel prices, but it also means it is lowers inflation outlook, which means that RBI will be forced to provide monetary stimulus to stimulate the economy, which can further provide asset price inflation. So, putting all of this together, what this means is, as long as Indian rupee is strengthening, from 72, it might go all the way back to 65, 63. You can have these current account surpluses for a time being. It's better, and you have this huge trend reversal in the small cap to large cap returns. All of this could point to a sustained small cap rally outperforming large cap for some time to come. Again, this is CPI, core price inflation. What I wanted to show you is that the chart on the right, the blue line is the headline, green line is rural, orange line is urban. We are not in two different worlds. It's not that urban people do things differently than rural people. We are now in the same India. So what you can see is that definitely inflation is true and happening everywhere, but look at the latest data. They're coming down, and that is what I was pointing to. So inflation coming down leads to RBI reducing rates, not increasing. So the bond yields that we saw hike up, that will come down when inflation cools off and RBI reduces rate. And if Indian rupee continues to strengthen because of this particular, the fact that we have current account surplus. I'll show you this chart, this particular chart, current account, we are in surplus. What you see is that while we try to cater for in bringing back inflation up a bit around the 4% level that we are targeting, uh, you could have a sustained period where small cap sort of does a lot better than large caps. So look at this chart now. It's basically the source and destination of imports and exports. The blue line is China. So what is this chart? This is Indian goods imports by destination and Indian goods imports and services. So while we might think whatever we might think about China from a corona point of view or a line of actual control news flashes, China is one of the most trading, important trading partners of India, not just in terms of volume, but in terms of, number of things. So that is something which, if it keeps shifting, and this is going to feed into the fact that, it can add to our current account surplus if we do not import as much from China, which will again point to strengthening rupee and cooling inflation and harder times for exporters and hence the large caps, and had thus the opportunity for small caps to reverse that around. So with that, I think I'll come to something. We have done a lot of global macro data. So what I can say is that if you sign up and probably open an account on our website, I will try to send you this presentation. If you Because then as an advisory relationship we can share research. um, so please go to our website, sign up. It's super easy. Go to small case, sign up. But one of the things that I wanted to point out is uh, an easy way, right? A kind of intuitive way to value companies quickly. So what you see is the fact that uh, we call it the napkin framework, right? What is this napkin framework? We say that, well, I mean, a company is valued by a fundamental analyst where they project cash flows for up to 5 years, and beyond 5 years is called terminal value. So terminal value is whatever is the value of the company as if it continues to perpetuity, right? So so usually, excuse me, just 1 second. So usually this value till perpetuity is 70% of the value of the company, and these 5-year projections typically account for 30%. So let's take a example, right? I mean, let's take a company which has a PE of 35. So what does this 35 PE really mean? It just means that for uh, 1 rupee of earning, right? So 35 PE means price per share divided by earnings per share. So if it's basically for 1 rupee of earning today, I'm willing to buy that 1 rupee of earning for 35 rupees today. So why would I want to do that, right? I'm just getting 1 rupee, so why pay 35 rupees? And the answer really is that, well, today the price is 1 rupee, but earning is 1 rupee, but I can see that it's going to far greater in the future. But can we kind of wrap around this number a bit? So what we can say is, okay, let's say that 70% of the value comes from the perpetuity. We can say for the next 5 years 30% must come from this. So um, if you're paying 1 rupee for earning today, it must account for 30% of 35, which is roughly 10 rupee in the next 5 years, or 12 rupees if you do the real calculation. So that means that what would be the compounding earnings growth so that one becomes 12? Or in very simple terms, how much should be the interest rate so that if you put 1 rupee today, in five years it becomes 12 rupees? Well, it turns out, I know it's quite a lot. So it's could be anywhere in the range of 40-50%. So if you're buying a company with a PE of 35, you're expecting the earnings to grow by 50%, right? And on an average, Indians earnings have grown by 6%, 8%. So that's like saying this company was going to do 5x better over the next 5 years compared to everything else in the market. It's a big claim. Companies do that. Smaller companies tend to do that more often, but it's definitely very difficult. But look at this interesting fact, right? So we keep talking about PE as we saw before, but see what happens to the terminal value when the interest rate shifts. So we all know that fixed deposits we are getting 8% per annum, and now we are getting around 6%. So if you look at a 25% discount on the future interest rate, so your terminal value now is inflated by 8% divided by 6% multiplied by 70. So 85% of the value now shifts to terminal value, and only 15% remain in the projected value instead of 30%. So now suddenly it's like, okay, I just need to grow half that, and I need to grow at 15% instead of 50% because of the compounding effect. That looks more reasonable. So that is what we are looking at, right? So when you compare to your valuations to historical PE, you'll see that none of that makes sense, right? I can't buy this company, it's 35p. I can't buy this company, 60p. I can't buy this. But you can't buy that because it's based on the history where interest rates were 20-30% higher. Now you got to recalculate. So that is the essence, right? If you're looking at factor based strategies, or you're trying to do these kind of valuations based on known ratios, this is one of the challenges you must encounter. So this is a framework which we have created for, especially which is technically somewhat based in theory, but it's very practical to apply, and we think it can help a lot to determine fair value. With that, I would like to go move over to questions. I see a lot of questions come in. I'm gonna go back to the original slide to see if there's some questions which I should take first. So one of the questions that has been posed is uh, increasing retail participation. This is really, Zerodha did a phenomenal job. I think we should all be proud of the fact that Zerodha as a company has created technology and scaled Indian brokerage market. I think it's one of the largest brokers in the world right now. So I think the question comes from that a bit, that increasing retail participation who churn a lot impact returns in the market. So doesn't, right? Because churning doesn't impact returns by others if you know what you have bought into. It's just buying and selling. It's the pricing, the value, that is really what drives. So if you see a lot of trading turnover, it doesn't necessarily mean it's a good or a bad investment. It's just the measure of activity in the market. So doesn't really impact anything. Let me quickly show you something which I wanted to show you. um, let's let's look at this. So this is from Money Control. You can see all the historical returns of small cap funds. In the last 3 months, the best fund would have given you a 33.86%. Our small cap strategy, listed venture capital, gave you 53%. And this is again available on the website. This is important because we have hardly any overlap with the holdings of mutual fund. It's a completely different way of selecting stocks. So there's a question that small caps have not really given good returns. Why is that you're insisting on investing in small caps? So I guess the answer really is that, as I explained, a lot of it is in the global macro. The question I think is, why now. So this is, I think, how we look at the world, and we have presented the data as to where this view comes from. So hopefully that helps you make sense of it. So I think one of the question is any future small cases. We are constantly working on developing exciting products. We have products where we invest in on behalf of clients in international markets. So we have basket of stocks in international markets. If you go to our website, you kind of go and open an account there. From there we can pick you up and get you international exposure also, like packet small case likes in international markets. So those are some of the things that we do in Indian market. Again, like we are constantly trying to develop new and interesting products. We'll definitely come back to you, if we can find a product that will be suitable for the audience here, and we are constantly trying for that. But these are very unique products. It's very hard to come up with unique products that actually consistently make money. If you look at our total returns over the last 2 years, we have 86% return. Over 1 year we have generated 62% return. These kind of, and we have outperformed the index by 34% as of today. So it's very difficult to beat the market. It's also more difficult to beat it by such a big margin. So we want to keep the barrier really high. We want to give you these kind of products which do well, and it just takes time and effort to find such strategies, and we constantly research every day. And we also have to look at the strategies that we are running. So a large part of the effort goes on monitoring the stocks that are in the small case on your behalf and basically covering them on a daily basis. So that's really where the effort goes in, on constantly researching on your behalf, spending time and making sure you're correctly positioned in the market. That's the main intent. um, so as I said, some there's a question like, what's the promising sector? um, I would answer it differently, right? The largest sector in indices in India is basically financials. Is financials going to be a promising sector? Our answer, and we think yes, because of the fact that a lot of uh, the chains that had been tied to the legs of financial, which was because of the NPA, now will get, they have found a new home in asset reconstruction companies that the finance minister proposed, in terms of setting up a AIF which will accumulate all the bad loans. That will propel rotation of money within banks. And I think therefore, given the fact that financials is the largest sector, it's hugely will be beneficial, and that's what's expected. So so I think that's really what we think is happening there. uh, so somebody said, yeah, I mean, it's pointed out 8% by 6% multiplied by 70. Yeah, in 93, 85. The point is, it's just a ballpark figure. Neither the fixed deposit rate was exactly 8%, neither is it 6% now. But thanks for pointing out. It's just a framework, right? Use your numbers, use your own numbers. It's just the way of thinking is what we are trying to present. Uh, does MF redemptions affect the market? Yes, I think flows always affect the market. Net flows, right? Not trading. So there was a question before, which is like churning, right? Retail investors coming in and churning. Does it affect the market? Not so much. People pulling out money, putting in money. Yes, it does affect the market, because it's, after all, also supply and demand. So the fact that there is a need for financialization of savings. So why did the Indian government, there was a time when you could get 14% fixed deposit, 15% fixed deposit, now you get 6% in fixed deposit? What really happened, right? Why did it come down so much? And the answer really is that, um, so the government of India had a lot of PSUs, still has, and they also borrowed to basically fund those PSUs. So if you think about it for a moment, so the Indian government bond also had some sort of a corporate bond like exposure. So therefore, the risk was higher, and hence the returns were higher too. What has happened since then is that Indian government is saying, okay, private enterprises, please create opportunities in the domestic market and find investors who are going to fund you for that growth, right? And the government is basically trying to say, we are going to slowly step away from running businesses. We are going to start running the government. And if that is true, that means that the bonds of the Indian government need not have the risk of a corporate. So therefore, the cost at which people are willing to lend money to Indian government is also coming down. But also there is a global macro impact right now. In, for example, in Germany, for lending to German government for 10 years, they ask you to pay you 0.5%. It's negative 0.5% interest rate, which is funny, right? So, it's like saying if you go to the bank and say, I want to put 1 crore rupees as fixed deposit, they say, yeah, sure, but you're not going to get back 99 lakhs after 10 years. Just, 99.5 lakhs after 10 years. Would you do that? I mean, no. But in Germany, people don't have a choice. Pension funds, they have to invest in government bonds. They keep on buying. So these are some of the problems. And compared to that, India is offering 6%, and Indian government has never defaulted on its debt, and it's priced higher than many governments who had defaulted on their debt in the past. So to a certain extent, it is correct when the Indian government points out that the rating methodology and hence the yield that which investors want to give Indian government is probably not fully transparent. But it's also the fact that in an emerging economy, policies and governments, they can change pretty quickly. So that's an added risk that people try to price in. But the fact is that it's in the best interest of the Indian government to reduce their cost of capital and hence the government bond yield, because that would allow them to borrow at a lower rate for a longer time and hence fund all these kind of infrastructure projects. So that's really what this is about eventually. So yeah, I think see broadly, what we have to understand is that uh, there's always this question about timing, right? Is this the right time? Should I get in now? Should I wait? And then the market goes up, and you're like, oh gosh, I should have gotten. Why did I wait? And then you go in, and the market goes down, and you're like, this must be it. And I must have seen that sign on TV which said that I know this was the wrong time. The fact of the matter is it's very very hard to time the market, if at all. But we, as a philosophy, we look at aggregated intelligence using AI. One of the things that we aggregate at a global level is the global broker margin data. So just to put it in context, what we do is, so you have a trading account, right? So you have some extra cash lying around. If you're very confident about your future bets, you're more likely to use more of the cash. If you're not confident, you're keeping the cash or you're probably pushing it back to the bank. But you're not really taking exposure in the market. So if you measure it in aggregate sense across the world with many public sources of data, what you can measure is that what is the general thing that people are doing with their money. Are they putting in money? Are they pulling out money? And you can use that to estimate the risk. And this has been one of the key pieces of research Dr. Prachi did. She's an expert in behavioral finance. For she researched that area for many, more than a decade. So so we use those kind of dashboards. We look at cyclicality of sectors and where people are positioning money. We look at the bond yields ratio. We look at the steepening of the curve. So we look at multiple indicators to kind of come to a kind of way of understanding whether this is timing wise, is this a good timing. Can we say something more than just tossing the coin, right, which is random. We think that there's still risk on. So we don't see the signals yet to pull out money significant way. Nobody can say a 5% correction, even a 10% correction, right? I mean, nobody can time that. But the structural trend again remains positive, just because of the the pure data that we see. So with that in my caveat there, if personally, of course, depending on your risk profile and how much you're willing to risk in terms of a drawdown, you must look at that. And as an investment advisor licensed by SEBI, it is my responsibility to ensure that your portfolio, you're not overexposed to to one particular risk, which might not be suitable for you. So yeah, please kind of do your risk profiling, and based on that, take an adequate exposure. Certainly. Right. So see, I think in terms of choices of small cases, what I kind of see out there, there are a couple of buckets. There's a value bucket, there's a momentum bucket, and there's a maybe sort of a factor based bucket. We are we are none of that, right? What we do is we completely have a different approach, a different take on the market. As I explained, we use a lot of AIML to do the initial screening. So for us, we look at the world very differently. We look at the world only through the data that we can see. We have very little kind of uh, gut feel into the portfolio, right? As a portfolio manager, experience is where your experience, intuition is where your gut comes from. But ultimately, we are all dependent on the data that we see. We don't know any better than that, and hence we try to kind of do what we are able to see. And the only edge that we have is we try to build technology, and we try to build systems where we can see deeper and further than ahead, than others. So that's really where what we focus a lot on in working and building the technology that gives you this kind of returns that you have seen. um, Most of our customers that uh, are with us, they have been with us forever, and they have made so much returns that I think we have customers who have put in tens of lakhs in the small case. We also have customers who have just started with one basket. They keep buying a basket every month or every week. We have a customer who buys a couple of baskets every week. So this is the advantage of small case, where you can, it's like a buffet of choices. You uh, eat what you like, but you make sure that you have a full meal, right? So ensure that what we always say is that uh, this is the price of the buffet, which is our small case. uh, you might invest in one basket just to try it out, but the idea is that you should scale your investments. It's a well researched package idea. So please take maximum advantage of it, because you can really get it at a great price in terms of being able to get all of this at any asset level, right? You can go and increase your asset level to unlimited amount, and you'll still pay this fixed fee, which is the business model that we support. So please go and make it yours. Make it, become a portfolio manager, manage your own money, but do it with a little bit of research help from people like us, and of course from LotusDew, because we are working every day very hard to make sure that your money grows fast. So with that, I think we are coming towards the end of uh, the thing. Yeah, there is a coupon. There is a coupon which uh, Abel will send. Uh, so the coupon is going to be part of the emailer that will be shortly followed in the after the video. Please look at that coupon code that is going to be applicable for you. It's a 20% discount coupon code, and it's going to be for new customers who want to come in. They can use it for one time purchase or for lifetime purchase. The choice is yours, but it's going to be made available to you. uh, how do you calculate CAGR and compare to Nifty? CAGR is nothing. It's super simple. So I'll tell you. It's basically, you have to learn a little bit of it's a bit of mathematics. So it's like, I made 50% in 5 years. What is my CAGR? And the answer there is that, what is the interest rate that you needed to accumulate 50% over 5 years? If you work it out, it's roughly going to be, I think. So if you, in your mind, what you can do is 72 divided by the interest rate is the number of years it takes to double money. So for example, if your interest rate is 8%, you divide it by 72, it's 9. So it takes 9 years to double money at 72, 8% interest rate. So if you take 50, it's half, right? This is 1.5x, is half of double. So uh, typically, you're talking about 6% sort of, CAGR to get to 50 ballpark, right? And I'm doing mental math, which is power mathematics, but roughly around that to get to 50 in CAGR of 50 over the next 5 years. But yeah, I mean, there are lots of tools in Excel and on internet to figure this out. But it's a good question. I think definitely you should start from the basics of calculation. Um, uh, the most important thing is that the more you know, the less the more you know, the more you'll understand what you want to focus on. So therefore, it's like, once you become a licensed pilot, then you understand that how cheap it is to fly commercially, right? So I think it's definitely a skill to manage, have the discipline to manage your portfolio well. But what you can do in terms of like managing your money, you can probably take a little bit of help in getting these research portfolio ideas as a basket, and then being your own portfolio manager. So I think we are just over time. I'll wait for a cue from Abel. Abel, how would you like me to continue?
Hi, I think we are a little bit on short of time now, so we have crossed time. But Abhishek, I really have to say, like the hard facts, the data that you pointed out to support the evidence of how the impact is on small caps is just brilliant, brilliant effort. Like how much you take the time to come here to explain on a Saturday evening. I don't think it's something that is very easy, especially when you're really busy, when you're working really hard for our investors. So I'm really glad that you took the time and you came out here. Thank you so much, Abhishek. How was your experience with the webinar?
No, well, thanks a lot. I'm busy because we have customers who have come here. I'm busy big for them, and I'm glad to be busy because of them. I don't think it's I call myself. It's a pleasure. Right? It's really always a pleasure to share knowledge and to share ideas. We always learn by sharing ideas with each other. So I'm very very happy, and I'm glad to have spent this Saturday afternoon with the small case customers and people who are interested in small case. I think definitely it's a great platform for you to try portfolio management on your own. So definitely happy to be here. And thanks, Abel, for arranging everything, taking care of the logistics
No
and so on.
issues. I mean, I also wanted to tell, like, so you said about knowledge sharing. So guys, please check out Abhishek's LotusDew YouTube page. I've put the link in the description box. Do check it out. He has some great content there where he talks about different topics on investing. So please do check that out. And also, I have put up in the chat box a subscription link where you can subscribe to Case by Case. Don't forget, so you get exclusive webinar invitations, you get promo codes. It's a ton of fun. You get to learn a lot. So please subscribe to Case by Case also. And yeah, and also subscribe to this channel if you haven't subscribed already. We have some great content coming up as well. And yeah, so please do follow LotusDew. Abhishek, I'm really glad that you to share things, because like you said, sharing is the way that people can learn better, and slowly each person or each investor at a time, India's investing is changing. So and you are part of that, and I'm really glad, I'm really happy that you take the time for that. Thank you so much, Abhishek. Any closing words from you before we wind up?
The only thing I would say, please don't always look at historical ratios to compare markets. Markets are always forward looking. They don't care about history, right? And we, history is just for the lack of foresight we look at history. Historical patterns repeat, but you know how the history is going to repeat is going to be a new story every time.
Got it, got it, got it. Thank you for that insightful words. So, thank you everyone. Thank you so much for joining in. We hope you all had a wonderful time. So, check back in, and we'll have more content and webinars coming up for all of you guys. Thank you, and have a great day ahead. Yes.